Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at 5 different stocks hedge fund managers are buying right now. These companies do not pay dividends. We talked about last week stocks that they're buying right now, that pay dividends. So if you like that video, go and find it in the channel. But today we're going to focus 5 that do not pay any dividends. Again, this is my portfolio. So before we get to this, actually, I just want to talk about one thing. One of the new subscribers, or maybe existing subscribers, actually asked me a question, and I kind of completely forgot the fact that, you know, there's so many people have joined the channel recently. I haven't actually had the opportunity maybe just to say who I am. I'm sure if you're existing, so if you were here in the last 5 to 6 months, then obviously you know who I am and what I do and so on. But some of you obviously are new to the channel. You probably have not seen me talk about myself, which I actually don't like talking about, but I just want to talk about stocks and what I'm doing right now. And the portfolio you see right now is completely and utterly my own money that I actually work for. I just got back from work and I'm absolutely exhausted, but I thought, you know what, let me put this video out there. So I do have a full-time job. My name is Mahmoud. First of all, I am married. I've got 2 children, 9 and 5. I've talked about that a few times here. So yeah, basically my background is I have a computer science degree and I work in the computer science industry. I've been working for 12 years now, to give or take. I'm 35. I'll be turning 35 next month. So yeah, alhamdulillah, I'm in a good place, and my wife and I basically make enough good salary, and we save everything we can, as much as we can, to be honest with you. And what we're trying to do right now is grow our net worth. So try to, buy stocks, buy properties, whatever it is, while the children are still young and we're still also young as well. So yeah, just that's my journey, that's who I am. And obviously about 2.5 years ago, I started looking into investments and start looking into stocks generally. And at the time, I was just a little bit skeptical about it. I didn't know where to go about it. And then in 2019 December, we went on a holiday to Dubai, and I went to this bookshop, and then there was a teacher, something called Teacher Millionaire, and I was like, what is that? So I picked up the book, and it talked about this basically teacher who actually became a millionaire through actually index investing. So I read his book and I was like really hooked. So I bought the next one. It was called Expat Expat Millionaire or Investor or something like that. And then I started reading more books about it. Then I picked up, again, I love reading, so I picked up the Intelligent Investor. Then I start looking at other books, like, for example, the Peter Lynch book, One Up on Wall Street. So I've then started educating myself. So by, say, January of 2020, just before the collapse, that's when I started basically start buying a couple of stocks here and there. I was using at the time HL, which is basically Hargreaves and Lansdown in the UK, and you pay about £11 for every single transaction or every single sell and a buy. And it was too expensive. I was looking for something else, so I found Trading 212. And then obviously the stock market started collapsing. I got a little bit scared. I wasn't sure what was going on there. Okay, so I sold everything that I had in the other account and moved to everything over here, not because of the crash. And that's when I started investing, and I bought companies that I absolutely had no idea what they do at the time. So yeah, basically it's been a long journey, but alhamdulillah, I'm here now. I feel like I've learned so much, and because I love reading, and actually I've got a couple of friends who are actually in the basically work in the investment world. It actually helped a lot because I can just share things with them. They can talk to me through things, and so I've learned so much. And I'm a quick learner. I love just reading books and learning about new things. So what you see here, I'm not just saying I'm an expert. I'm just sharing my journey. Okay, and the analysis and things that I've basically done is things that I've learned and taught myself in the last few months. And obviously with the help of my friends and so on, I've managed to actually be in where I am right now, alhamdulillah. And the money that you see is basically money that my wife and I save every single month and put it back into the stock market. So every penny that you see is literally did not come from a hair. Basically, let me tell you this, right? I'm the first in my basically family to go to university. So I have not got any basically money from my father or my mom or anything like that. It was just the money that I actually saved and put into the stock market, and you see it growing every single day. Not because actually the stock market is doing really well, it's because I'm putting a lot more money, and my goal is inshallah to put basically about 100 grand to this account and then move on to maybe another account, just kind of diversify my portfolio. Yeah, that took 5 minutes, but I hope you know who I am now, and if you have any questions, as always, just let me know. So today, like I said, we're looking at 5 different companies hedge fund managers are buying right now, and that's what we're gonna do. We're just gonna, sometimes it's good to know these things, okay, like I said, and they have got a lot more research than we do. So let's get started, and I'm just gonna do a very quick summary of these companies. So if you're really interested, you can do a little bit more, dig deeper in the next couple of days and find out a bit more. But the first company we want to look at is Adobe. Okay, I'm sure you know Adobe and what they do when it comes to content creation software side of things. When it comes to PDF editing, they are the company to go to. And recently, because they moved away from just selling things on CD and now it's a subscription based, they actually now we use it in our company, and obviously that subscription has to be renewed every single year, and that's it. So that recurring revenue is actually there now, and that is really good to see. When you look at their keys like their net income, like 23% of net income, and when you look at the operating margins of 36%, when you look at the return on equity, okay, 35%, return on asset 18%, 19% almost, and the net margin is almost 30%, is great. And then look at that free cash flow there. So really, genuinely, the great company. But when you look at this, you're like, what is going on here? Okay, it's undervalued at 24% discount at the moment. And the story is right now, the stock is the market is open right now, so it's $367 per share. And when you look at this, okay, the 5-star price. So Morningstar uses basically this star. So 1 is the most expensive, 5 is basically the cheapest. And in order for this stock to actually get to 5-star, it just have to be 350. Right now, it's about $17 off that basically, okay. And so it's almost a 5-star stock. And the most expensive, or like 1-star, will be $675 per share. As you can see, it has a wide mode, and this capital allocation, this means basically the company is actually, the management of the company is allocating that money, the basic revenue they get accordingly, and they're using that money really wisely. So it is a great company in terms of their financials and so on, and is one of the companies that I own actually in my portfolio. So this is the first company they're buying right now. So I'm just going to quickly show you their revenue basically, okay. So 2018 was about $9 billion, and right now we're looking about $16 billion. That's how much it's actually grown. In terms of their cost of their revenue, okay, from 1 million, okay, to right now 1.1 to 1.9. So it hasn't grown actually that much, because remember, they create this software, they obviously update it every single year, tweak it here and there obviously to make it better and so on, but it doesn't cost a lot. So they don't have that much of a cost in terms of the cost of the revenue side of things. Gross profit from $7.8 billion to right now 14. EBITDA from 3 to 6.6 billion right now. And then when you look at their free cash flow, from 3.7 billion to right now $6.8 billion. So they really, I mean, look at that. Just that's just genuinely amazing. Like that free cash flow there, the growth of it from 2018 to right now, okay, you almost double that money. And according to Simply Wall Street here, you can see they think basically it's about 34% undervalued at the moment. Their price tag is about 590. Same goes for Tip Rank, more or less the same, 20%, 469. So everywhere you look, even the Yahoo analyst is actually saying 466. But next 5 years, they're expecting basically the earnings to grow about 14%. Okay, so this is a solid business. Genuinely is one of the best companies out there. Is very much discounted at the moment. So if you're looking for a growth company, then that might be one that you look into. And I understand why they basically trying to add in this to their portfolio, because look at the numbers. Okay, and according to the website Dataroma, there were 6 different hedge fund managers that actually bought Adobe company, the stock. So the next company we're looking at is Shopify, and I'm sure you know this. What this company does is the e-commerce company provides a commercial platform and services in Canada, United States, and so on, where buyers can go in and buy stuff, and you can set up your own channel, basically company, if you like, okay, in there, and then sell your own products. Right now, when you look at their net income and when you look at their profits and return, it doesn't really look that great, and the free cash flow is just about 253 million. Okay, but when you look at their current market, this company actually came down. Let me actually quickly see. That's 80% down, 80% from its all-time high, 52-week high. That is really crazy. But at some point, I think it was about 1,000 something, or if not 2,000, the price. But right now, as you can see, here is $351 per share, market cap of $45 billion. P is very, very high. Price to free cash flow, very high. Price to sales, it's not bad actually, price to sales. Okay, EPS, because these growth companies are normally, I look for about 15 or basically less. EPS is heading in the right direction, is growing. Current ratio is actually good. Beta is actually higher than 1. Obviously, that means it's quite volatile. And then in the next 5 years, they're expecting the EPS. And this is probably one of the reasons why this stock is valued so much, because of the growth in the next couple of years. But the operating margins and sales, basically operating margins not that great, and the net incomes, the profit margins and so on. But this is, remember, this is a growth company. It actually went up so much, and right now is actually heading downwards, if you like. But I'm sure if the company will be around for a long time, and it will do well, but it's just going to come down. Unfortunately, I don't think it's going to go higher from here, because of the type of business it is, and what basically is happening right now, especially if we end up in a recession and so on. Okay, and as you can see here, from 2018 to right now, the revenue is growing. So from 1 billion to now 4.8, and then when you look at the gross margin, is actually getting better. The EBITDA is actually getting better, from negative to a positive. Free cash flow again from a negative to a positive. So definitely heading the right directions. And according to Yahoo, Morningstar is actually fairly valued. According to Simply Wall Street, is actually undervalued about 7%. According to TipRank, is actually undervalued quite a bit. And then Yahoo Finance is actually $849 per share. But if you look at the next 5 years in terms of growth side of it, basically, apparently, according to Yahoo Finance, is about 19%, minus 19%. So it's not growing next 5 years. So I'm not sure what the fuss is about, but there we go. They are buying it, and they must know something that we don't. So that's the second company we're looking at. The next one we're looking at is Salesforce Inc. Salesforce is a company that I own, and I've talked about this company for so long, and I'm sure you're sick and tired of by now. But it's one of those companies that, like right now, it's 5-star stock. Okay, and when you look at the key ratios, it's not bad. Okay, it's not great, but it is not bad either, because it is still a growing company. Okay, so the fact that they've got $5 billion, $5.7 billion in the bank, it's a good, right? But it's still a growing company. And when you look at the 41% discount at the moment, can you see $305 per share? That's their target. That's basically their fair value. If you look at it right now, we're looking at about, basically their 5-star is 213, but it's right now, if we look at it, $172 per share. So in terms of growth side of it, it's actually done really well. It has a wide moat. It has a business model that is very, very sticky, and the reason for that is because once you're in their platform, in their, if you like, their environment, it's actually quite difficult to leave this company. Because if you buy into their packages, for example, and you do basically they host in your website or whatever it is, then they obviously analyze that website for you, how many traffics that's coming in and out of the business, and they also look at your customers, where they're coming from, their habits, and all of that data is analyzed and shared with you. So they have so much different basically things that they use to kind of hook you in, and once you're in that basically environment, is actually very, very difficult to leave. And one of the things that I actually like about this company is this here. Okay, so from $13 billion to 27, almost $28 billion of revenue. So 2019 to right now. Okay, and this is the growth if you think about it. And they taken about 20 billion of that 27. So they're spending about $7 billion on that. And EBITDA exactly growing as well, from $2 billion to $3.8 billion. For a company that's growing, that's really good. And then when you look at the free cash flow here, $2.8 billion to $5.7 billion. And again, when it comes to fair values and all that stuff, I mean, the valuation side of it, you can see is almost 40% discount. And when you look at the Simply Wall Street, is a 43% undervalued at the moment. Tiprak is more or less 30%. Yahoo Finance says 268, 46, okay. And again, next 5 years, 16% growth, and it has wide economic mode. So again, it's a great company. Yes, the PE is slightly higher, but price to free cash flow is about 29. It was way higher than that, and the PE was way higher than that. So I'm not justifying, but it's basically important to look at other metrics, especially the growth side of it for business like this. Okay, and this is one of the companies, actually, like I said at the beginning, I own in my portfolio. And the next company we're looking at is Booking.com. This is one of the companies, if you've ever been on a holiday, and you want to book a hotel, car, whatever, that's the website to go to. This is the one I use all the time if I'm going on a holiday. Again, it's a great company. I mean, their business model is actually, they own loads of different websites other than just Booking.com. That's what actually I was quite surprised, because I was thinking, how come this company is doing so well? So when I went to their website and just checked out the kind of businesses they own actually loads of different websites that I didn't even know nothing about. So right now, as you can see, about 27% discount. It's 4-star right now. At some point it might hit those $3,000 per share, but right now we're looking about $1,800 per share. It doesn't have a wide mode, it has a narrow, because again, it's one of those businesses that anyone can come in and disrupt that whole industry if you like. Okay, and when you look at their revenue for the last, just quickly show you, net income is not that great, profit margins not, again, because it's growing, but they do have a nice free cash flow here. Again, the PE is quite basically high, but price to free cash flow, okay, is actually quite low, which is nice to see. And price to sales tells me this stock is definitely cheap if you think about it. And for example, the EPS next year, I don't know exactly if this is true or not, but EPS from $12 per share to $130 per share. They must have actually made a purchase recently, because how could it jump that high? It will be interesting to find out a bit more the next. If you're doing a little bit more research, go and find out about that. So when we look at their total revenue, for example, from $14.5 billion to right now $12.5 billion. Again, why? Because of COVID, because we were locked away, no one was going on holiday. Their operating expenses, you can see, from $9 billion to still $9 billion. So it hasn't grown much, but the EBITDA from $5 billion to $2.3. So this is one of the companies that is reopening, whatever they want to call it these days, okay? And free cash flow, again, $4.8 billion, and it has declined. Not because the business is no longer doing great itself, is because of COVID, because of everything that has happened. But it looks cheap from whichever company you look at. Okay, from Morningstar 3,000 to 3,300, from Simply Wall Street 2,600, and next 5 years the growth is 51%. That's probably why it's so expensive right now. So there you go, another company to look at. Another company these guys are buying. Basically, there's about 5 different hedge fund managers that actually bought this stock. If you haven't subscribed to the channel yet, or you haven't liked this video yet, please do so, because it really genuinely helps me a lot. It helps the channel a lot. And as you can tell, I apologize if my voice is all over the place, because I'm a little bit tired right now, but then we're going to carry on. And the final company we're going to talk about right now is ServiceNow, the ticker symbol NOW, and it's again another 5-star stock. When you look at the key ratios, again, you can tell this is a growth company, because return on equity, return on investment, and on assets and things like that are not really where they should be, but they do have almost $2 billion of free cash flow here, and they are 5-star, but 29%, almost 30% discounted right now. $490 is the 5-star position, and right now when you look at it, 270, they're down 5% just today, or $25 per share. So 471. Okay, so right now we are looking at basically stock that is a proper 5-star right now, and they do have a wide economic mode. And when you think about the company, okay, it provides software solutions to structure and automated various business processes in fire, SaaS delivery model. And this is again another one of those companies that are very similar to CRM or Salesforce, where they basically deal with HR and the security and all of those things. But one thing I exactly love about this company is the fact that it's again another SaaS model, which is really, when it comes to software, that's what I look for. I look for companies that have a recurring revenue, because having a software as a service model means basically the company is basically, the other companies that use your products will come back again and again, just like Adobe, just like Microsoft, just like Salesforce. Okay, and this company is down quite a bit. And when you look at their PE, it's actually quite high, and price to free cash flow and so on. But like I said, again, another growth company that's gone down so much this year. When you look at 33% from its all-time high. Okay, and from last 5 years, $2.6 billion of total revenue to right now $6.2 billion. So it's heading the right directions. And gross profit from 1.9 to right now 4.8. EBITDA again in the millions, so 160 to now right now 700 and almost 50 million. Okay, free cash flow, and you're looking at from the millions to right now $1.9 billion. So again, when you look at the Morningstar valuations, we've already seen that Simply Wall Street is actually giving us about 400, almost close to 500. Okay, Tip Rank is again similar, $621 per share, and Yahoo Finance. These two are very similar when they look at basically 12 months price target, whereas these two are very similar. But although they don't agree with everything, the model they use is basically discounted free cash flow model for these companies. Okay, and the next 5 years the growth is about 38%, and it has a wide moat. So this is another solid business that if you're looking for, a software company, a SaaS model, and you want to get it while it's still cheap, have a look at this company. Like I've always said to you, I'm not a financial advisor, but these are, companies that are trading really cheap right now. So if the stock market goes back up again, people will start jumping in and buying this company. Why not look into it while it's still cheap? Hence why I keep dollar cost averaging into my portfolio, because I know in the end of the day, I don't care what happens, I'm gonna hold on to this portfolio inshallah for the next 5, 10, 15, 20 years and plus. Okay, and right now, I might be up one day, I might be down one day. At some point today, I'll show you, like, in fact, it was over £53,000. I'm like, oh wow, that's a new milestone. And then boom, all of a sudden it's now 52. So it lost about £600, give or take. But again, it doesn't bother me, because I'm thinking about another 5 to 10 from now on, kind of thing. Okay, so that's my portfolio. Everything you see here is actual money that I worked hard for. And like I've always said to you guys, I'm only sharing my journey. I genuinely do not, basically, this is my money. Okay, this is not money I inherited. This is not a fake account. It's a real money in my ISA account. So I hope you like that transparency. If you're enjoying this kind of content and you haven't liked the videos yet, please do that, and let me know if you have any questions. I try to answer as many questions as possible, and I apologize for I'm genuinely tired. I just need to go to bed now because I'm so tired today. But inshallah, I'll be releasing more videos over the weekend. Have a wonderful day. Assalamu Alaikum.